So we've accumulated costs, we've talked about physical flows and the accounting flows. Now we want to start thinking about ending inventory and the valuation of ending inventory. So we're looking at valuation of ending inventory. And simply put, inventory, just like most things in life, can go up, can go up, can go down, can go up, can go down. And the conservatism principle that exists in accounting is conservative. And there is this principle called conservatism. Which basically states that when you, in your balance sheet, in your assets, when you have losses that exist within, specifically when we're looking at these kind of short-term assets, inventory is one of those short-term assets. When we're looking at these short-term assets, we should, if the value goes down, we should write down when there are identifiable losses. So we're looking to write down assets when there are identifiable losses. This conservatism also comes down to we recognize expenses immediately when they're probable and they're incurred, but we don't recognize gains until they're realized, right? So the conservatism also relates to when do we recognize expenses versus when can we recognize gains. Gains have to be pushed off until we actually realize them, when we are able to recognize it, when there's high likelihood we're going to get the money, et cetera, et cetera. So conservatism basically says make sure your assets are the most conservative. Not the most conservative, but conservative. So when we think about inventory has a basic valuation principle. So the basic valuation, what's generally accepted. So valuation for inventory is the lower, right? Very consistent with conservatism. The lower of the cost. So we went, if you go back to the videos, all the different costs. So whatever that accumulated cost is. If the cost is lower, then we keep it at cost. However, if something happens, it's going to be, we may have to go to a lower number. And that lower number is what's referred to as net realizable value. So it's the lower of the cost or net realizable value. And I'm going to put a slash here because there may be different cost flows where net realizable value is not what we should be using, but we should use market or replacement cost. So lower of cost and net realizable value, or lower of cost or market. And this market, I'm just going to put parenthetically here, this is replacement. Okay, that's the replacement cost. Okay, well, we talked about cost. Well, what the heck is net realizable value? Well, let's think about that, right? So when I sell inventory, I'm going to sell it for some price, some sales price. But that's not the net realizable value because there may be discounts that are associated with that. There may be selling costs, etc. And so net realizable value, I'm going to abbreviate this NRV, is equal to whatever the sales price is minus what would be normal selling costs, or what would be typical selling costs. And this might be the net sales price, right? So it may take out those sales facilitation charges, and the selling cost might be commission and things of that nature. So this is net realizable value. So when I'm looking at what my cost is, if I take the sales price less my selling costs, and that's lower than the cost that I put it in there, I've got to write this down. Now I'm not, I'm writing it down. There's still going to be some profit there, but I've got to write this down to at least net realizable value. And in that case, I'm going to basically make no money when I do sell this. So that's the valuation standard. That's the valuation standard. That's a judgment call, and that's a judgment call. We know what the cost is, but these are judgment calls. And management may say, we still can sell this at a high price and we don't have high selling costs, so we don't have to write down this inventory. Okay. That's something you have to understand, that there's a bias against doing this. There's a bias against doing this. So if the net realizable value has to go lower than this, then I'm going to lower the cost. I mean, basically, you're going to write down inventory to net realizable value. And then when I do sell that piece of inventory, there's going to be zero profit on it. Let's see how that works. So say, for example, I have a piece of inventory with a cost equal to $5,000. And I was originally planning to be able to sell this, the sales price on this, the original sales price was $8,000. My normal selling costs, I'll abbreviate that SC, my normal selling costs are around $500. And that might be due to a commission, whatever, right? So I would do this comparison every year. The net realizable value at this moment in time is $7,500. And I would do a comparison of that to my inventory cost. All right, this is the cost that I accumulated. But I haven't, if all of a sudden I'm seeing that I'm not able to sell this at $8,000, not able to sell this at $8,000, I have to keep on discounting, and I get to the end of the next year, and the new selling price, drops down to $5,000. Then my new net realizable value, I still have to take into account my selling costs, my normal selling costs. So my new net realizable value is equal to $4,500. My current cost in inventory is $5,000. Net realizable value, $4,500. I have to take, at the end of this year, because I have to write this inventory down, I have to take a $500 charge and that's going to go into cost of goods sold in that year. So I'm going to reduce the inventory cost by 500, and I'm also going to reduce my equity by 500 because I have this new expense.